Now we can move on to a segment. It kind of step Brett's going to take that. The problem of investing in concept stocks. I think it comes out of we get a ton of questions on individual companies, some large, some small, some of the smaller companies, because we like to dig into the cash flow of the business, look at helps us value where what how the business should be priced. But sometimes we get these concept stocks, very often where you don't have an underlying cash flow. You might not even have revenues, and how do you value them? Well, let's look at some of the problems we have kind of looking at these individual companies. If Brett's going to start that.
Yeah, so what actually sparked my really look into this was Brennan's company last week. He did Drone Delivery Capital, which we just said wasn't investment worthy, but we were really saying the concept is cool, it's an interesting technology, and it could go somewhere eventually, but the company at this time just isn't good, frankly. And so, yeah, I started to look into concept stocks. So you're probably asking, what is a concept stock? It's not something you'll hear widespread. It's not like a super well-known or super commonly used term, but it is quite clear. A concept stock is a company with substantial historic losses normally, and in many cases, little or no revenue. And investors need to buy into a concept. So an idea, instead of the underlying financials, like what we like to do. So we've recently seen many high-tech concept stocks in tech, things that are commonly in AI, electronic vehicles, practically anything that Kathy would be interested in her big industries. Those are commonly concept stocks because they're just not producing revenue, and if they are, it's probably not much. She does invest in other things, I should say, but a lot of her holdings are these concept stocks. But they aren't always high-tech. Actually, quite historically, we were seeing oil and gas exploration. That's something we commonly see on our CDR sweeps right now. I know Brennan and me have been going back and forth talking about how many stocks do go on CDR. So there's thousands of stocks on CDR in Canada. If you don't know, you'll never hear about them, and for good reasons. They'll never produce any profit, but they're just eating up shareholder capital. And because what they're trying to do is sell a concept that, hey, we got this plot of land, there's oil on it. But lots of times there's not an economic amount of oil, and if there is, it's hard to extract. And for every, let's say, 30 companies, you might have one that makes it. So that's really what a concept stock is. It doesn't need to be a certain industry. It's just not profitable, and the management is really trying to sell you on an idea of future value and not current value. So another common trait of them is they're going to collapse in the short term. One of the papers which I looked at was a 2006 paper called The History and Performance of Concept Stocks, and it had a ridiculous amount of the average lifespan for concept stocks was about 3.5 years. Think about that. You're buying a stock and it's going to collapse in 3.5 years. I have held stocks in my investment life, and I am not very old compared to especially these guys here. Had to take the shot. Had to take the shot. And I've held stocks longer than that. And most stocks you're thinking about holding at least potentially in perpetuity, so forever. Concept stocks, most likely you're not going to be able to, because it's going to be sold off, the assets are going to be sold off, your stock price is going to be a fraction of a cent, and sold just to get an instant listing. So that paper, which I was referencing, let's look at historical data, that's what we focused on, and they used data from 1967 to 1999, and on average they found the concept stocks, which they define as the stocks with the top 10 highest price to sales. So a high price to sale means either the sales are super low, so your revenue is super low, and the price is high normally. So that's the top decile, so the top 10%, and that's what they use to define concept stocks. And those stocks over their period perform worse than the broader market. Shocker, the stocks that are collapsing in 3.5 years are worse than the ones that you can hold for long periods of time. So this stock, the data they used was up to 1999, and you can see right in their data, which I'll pop up for our viewers, that you'll see a sharp turn right up before the dot-com bubble. And that's probably one of the biggest systematic increase in these concept stocks. But I would argue we're seeing those even more and more common these days. We're seeing like cryptocurrency, AI, EV, where some of the market companies, I'm not going to lie, they have promising futures, but a lot of them, no sales or low sales and no income. So what really is the issue with these concept stocks? They can't be valued. It's as simple as that. So most valuation metrics, they'll use net income, cash, or some intermediary. So you'll use EBITDA, something like that. But all you really need to know if you're not looking into these very deep is cash is king. Net income is probably second. And you'll see a various adjustments. It depends on the industry exactly. But the issue is with these concept stocks, you don't have earnings. You can't have cash flow. So what do you use? You might use sales if they have revenue. But a lot of them don't even have that. So what do you use? You'll see in the dot-com bubble, they use stuff like clicks. How does a click convert to cash? It's very, very nebulous, and you can't exactly get a good metric off of that. So they are quite, to say the least, speculative. And they'll commonly rely on, you'll see in the management, the industry is $700 billion. We're going to take 1% of that. But most of them don't. So what they have to do, they're extrapolating out, we're going to take 1%, we'll make a 30% profit margin, and we're good. We're this, already should be valued at billions and billions of dollars, even though we haven't hit even a cent of profit or a cent of revenue. And, of course, they'll say, hey, you just got to trust us. These values are great. We have no management experience, or we're on our 5th company in 10 years. But you should trust us, and we'll just pay ourselves some stock comp on the way. So a current example of this, which I'm not going to be as negative, that's a bit of a hyperbole, what I was just saying, but is First Hydrogen Corp, symbol FHYD on the TSX Venture. It is a company that's designing hydrogen utility vans, and they sell hydrogen as a service, which they're essentially selling the equivalent of gas pumps, but for hydrogen vehicles. And that's really what their long-term goal seems to be, is create a market with their hydrogen vehicles and then sell the pumps and the hydrogen, which they're buying off a third party, as an upsell. So the company is currently trading at $4.80 with a market cap of $238 million, and it is up 176% year to date. So it must have great financials, right? You're seeing a company go up 176%, and we're not just talking a very tiny micro cap at this point. We're talking a couple $100 million, so it at least should have some substance behind it. But no, they made a whopping $160,000 in their last quarter, or 2 quarters ago, sorry. And that's the only revenue they have ever had. That leads to an absurd price to sales, which, by the way, this number is meaningless. I'm just using it for an example. 1,486 times price to sales, which is already in my opinion, generally a poor metric. You can use it to support some things, but you don't really want to rely on it. So it's a concept stock. You're buying in the concept. They have a timeline of in about over 24 months. They're trying to push their initial vehicles as some fleet tests, so they do at least have some operational substance behind them, but the financial substance, you're looking at least 2 years away, and that would be very optimistic in my opinion. And that's the problem with many of these concept stocks. It's a race against time. So like I said, they have two years, let's say. They have 3.7 million cash and about 900,000 in other current assets, which is like inventory, accounts receivable. So you can normally get some sort of money back quite quick on those. You can sell off the receivables, get a few hundred more $1,000. So let's say $4 million. They used $6.6 million in cash over the last 6 months. So you see the problem here. They're spending. They're not bringing any cash in. So what are they going to do? They're raising money through shares. Let's dilute our stock. They got 7.6 million in the same 6-month time period. But they have been lucky. Their price has still went up. Their share prices went up. So they haven't had to dilute some. Like we see many other companies, especially those exploration oil and gas companies, they'll just dilute. And as the share price goes down, you need to dilute more. So if you're an early shareholder, you believed in the concept, your money's gone. You're going to get a 1/100th of your initial money back, even if you're right. And that's really the issue. So in summary, concept stocks are extremely speculative, have poor valuation models, and on a whole perform worse than the broader market, which is why we generally avoid them.
Well, we don't generally avoid them.
Well, we do avoid them, I should say.
Avoid them. We generally completely.
We talk about them. That's what I was more getting at. We're willing to talk about them.
We despise
them.
Yeah. Yeah, I mean, no, it was
on
good.
This show, we'll talk about them, but we'll never invest.
Yes,
in them.
That's different. I mean, we might even do a star, like have a company of a star. That has nothing to do with whether or not we like the company. It just has to do with whether or not the price went up. Sometimes we'll do a star and a dog, and we actually like the dog as an investment long term. We hate the star.
Well, that's actually how I came across this company. I ran a screener looking for stars and dogs. 176%. Haven't heard of this company and has at least somewhat of a market cap behind it.
Oh, yeah.
But yeah, that's how I ran into it.
So I take exception. I take exception to one thing there, and that was how concept stocks were tracked. Because you mentioned that they were tracked based on price to
Yeah.
sales, high price to sales.
It's not perfect, but I was
No.
going to criticize myself
Yeah,
too.
because
for that,
I think that most of them don't even have any sales.
No.
So
But
you wouldn't be able to track
Mhm.
them on that.
Unless
So-
it had a zero
It would have a
price
zero,
to
so I
sales.
assume they would have counted as the highest bracket. That's what I was thinking that they were
a
doing.
zero
So this
price.
wasn't a
the
zero
ratio,
sales.
just if they had zero.
Yeah. So
sales.
So they were just counting that as the highest decile.
Yeah, I mean, you would just say infinite then.
Yeah. Exactly. Yeah.
Infinite. Yeah. Okay.
Over zero.
Yeah, no, but I mean, I get that they have to have some type of a standardized
Mhm.
metric as opposed to just picking them every year. So I totally understand why they do that. I just think that if you actually calculated returns and you had all the concept stocks in there, many of which would have zero sales.
Oh, yeah.
So did they actually do that? Did they have an infinite?
I will have to look. I'll
Don't
put it
even
up over
worry
the screen,
about it. It
but I'm
doesn't
not
matter.
sure. Yeah.
Just out of curiosity. So maybe they actually did. Maybe they said, this is
Mhm.
infinite or whatever.
Yeah, it was based off the U.S. stock market as
Yeah.
well. In Canada, we do have a lot more small caps and these micro caps.
Oh, we would have.
So I would guess we're a lot worse here.
Unfortunately, it would be 95% probably, or
Mhm.
something not far off for the TSX Venture. A little bit better in the yeah. No, that's good. I mean, it's something that people need to know, and I think it's good to discuss this because retail investors get duped by concept stocks all the time, and I'm not trying to. I should actually say retail investors, institutional investors too, all investors, right? And it's we've always said, if there's one thing that an investor can do to easily avoid risk, the most possible risk in just one decision, and that is to not invest in companies that aren't generating profitability, right? And that's, right away. Are you going to miss a couple moonshots? Sure, you might miss, you will miss a couple, maybe not, but you're going to still be much better off because, you don't know what those moonshots are ahead of time. So if you invest in 100 concept stocks and one of them goes to the moon, I mean, it has to go up more than 100 times. It has to go up 100 times then just to make your money back, right?
And I think the misconception is that the only way you can get a stock
Mhm.
that goes up, thousands of times, is by buying these absolute concept stocks. Where in actuality, the only stocks that I've really seen, over 25 years have those type of moonshot returns are businesses that actually had cash flow, revenue, and
Mhm.
earnings when they started, and increased those over time. So they probably, and many of these companies like the Boyd groups that are up, 8,000, 10,000%, right? They had an actual business and traded at valuations that were lower than XYZ Mining Inc. or ABC Mining Inc. that had a property somewhere, anywhere in the world, that moose pasture that Brennan visits in Saskatoon, that's a property all the time. That same company had a higher valuation than when, say, we bought Boyd or Expel, and you don't have to take those type of risks that people think they have to make those moonshot type returns in your portfolio. You can find great businesses. I mean, even today, like Brennan just mentioned Dynacor. Well, they have a moose pasture in Peru too. We wouldn't really care about that in the valuation, but there's many companies out there that Dynacor has $100 million market cap, for example, today. They have 40 million in cash, right? So and slightly above that, but you can have that blue sky of that property. They have a property in Peru there. These many companies have $150 million market cap with that moose pasture that they're drilling sometime, or they're raising a bunch of money.
There's no moose in Peru, right?
Yeah, no, well, it's still a moose pasture. I don't know. That's all I call. I see that. That's
a sheep or a.
But bottom line, you don't have to take those risks to have those type of returns. So that's what we kind of try to stress to our clients all the time, and to investors. Anybody who wants to listen to it, that don't take those risks. Buy 5 or 10 stocks that have great underlying fundamentals, that have really strong growth as well. There's more of a chance that those are going to be the companies that provide you the moonshot type returns, those 2 or 3 stocks that you really need in your lifetime to change your portfolio that we talk about. As for a proxy in the Canadian markets for what concept stocks will do, I encourage you to look up the TSX Venture. look at the chart on that since the inception, essentially. I think it was in October of 2006. I'm going to pull it up here. 2,456 around that. Today it's 562. So I know it's not the best way of looking at it, because like, you know, the companies that do the best, like XPEL was originally listed on the TSX, then graduated off of it, but its returns, significant amount of its returns before it jumped off it, were there. But anyways, if you look at the terrible returns of the Venture Exchange, which has a ton of concept stocks on it, you can see on average over time, these companies do not do well. They're just too much speculation in these businesses. Like me and Aaron always say, just if you want to have that type of crazy fun with your money, just go to Vegas and put it all in black or red, and you'll have more fun, and you'll probably have the same outcome in the end.
Not my idea of a good time, but the Vegas part sounds good.
Some food and some shows.
Like also I'd like to add to just on these concept stocks. It's crazy how some people try to justify these crazy valuations. Like there was this one telehealth company that I kind of got into it with this one individual that was trading at 15 times sales. And that's what, you know, he said to me. He was like, you know, basically saying every growth sector in today's zero interest era is valued based on EV to sales rather than, you know, cash flow or earnings. Yeah. You know, he's basically saying, look at where he says, that, you know, look at every company.
That statement.
Oh, exactly.
That was 7
and you know, and he's
saying,
look at the tech space such as Zoom, Tesla, you know, Snowflake, etc. All of these businesses,
we're looking
high performers.
Exactly, you know, high performers, and even this one telehealth company that I'm referring to, and I was saying, like, I mean, it's 15 times EV to sales. Like, come on, man.
That's
you know,
good.
This stock is down over
90%.
You know, since I had this conversation with this individual,
and he still thinks you're a moron for not buying it.
What about your review? Yeah, I'm sure he does. What about your review on Cielo Waste, which was a complete concept stock? You know,
same. Yeah.
You know, same thing.
I love how it's the investors and the concept stocks that are always the most sensitive about anybody saying
told us we didn't know what the hell we're talking about.
I mean, I invest in a company that's got like growth and earnings and cash flow, and somebody says something bad, I'm just kind of like, oh, it's producing cash flow, it'll keep doing that, so the market will you know. But it's
Cielo went from $1, I think it's at 5 cents today, right? Well, you know, it's just what can happen in a concept stock when people actually say, hey, wait a minute, there's
and that's maybe why people are so sensitive, right? Because deep down, whether consciously or not, they recognize that the only thing that's keeping that up is psychology. And if you attack the psychology, then the stock goes down and they end up looking like complete morons.
Yeah, I mean, it's a house of cards.
And like on Cielo too, like the CEO was selling at like the high of like $1.20. Someone was on the internet was coming back to me saying, no, he's actually got more shares. And then he ended up stepping down, you know, like months after the absolute decline of the stock.
And that person still stands by their statement.
Probably. Anyways.